Hello everyone, welcome to my channel. The paper I will read today is the Debt Maturity Structure and Liquidity Risk. This paper is written by Douglas Diamond. The reason why I would like to read this paper is because I'm doing some research about the maturity structure and the monetary policy. I want to I want to design a kind of modeling framework to model the short-term and long-term interest rate uh, in different ways. So that is why I'm reading some papers related with the maturity structures. So this paper is written in 1991 and it is one of the most cited paper in the finance field. Let's begin. This paper analyzes debt maturity structure for borrowers with private information about their future credit rating. Borrowers' projects provide them with rents that they can not assign to lenders. The optimal maturity structure trades off a preference for short maturity due to expecting their credit rating to improve against liquidity risk. Liquidity risk is a risk that a borrower will lose their non-assignable rents due to excessive liquidity incentives of lenders. Borrowers with high credit ratings prefer short-term debt, and those with somewhat lower rating prefer long-term debt. Still, lower-rated borrowers can issue only short-term debt. Introduction and Overview. This paper analyzes the choice of debt maturity by firms. Short-term debt matures before the cash flows arrive from a firm's investments and must be refinanced at terms that depends on its future credit rating. Long-term debt, in contrast, has maturity matching the timing of the cash flows. Maturity is thus measured relative to the timing of arrival of cash flows rather than calendar time. In this paper, I ask how borrowers choose maturity structure and how their choice depends on their credit rating. As a stylized fact, firms with higher credit ratings issue short-term debt directly to investors. Firms with lower credit rating issue long-term bonds or borrow through financial intermediaries such as banks. The lower-rated borrowers' bank loans are relatively short-term. Borrowers who rely heavily on short-term debt are then a mix of the very high and low-rated borrowers, with the middle-rated borrowers using more long-term debt. This paper develops a model that explains this behavior. Debt maturity choice is analyzed as a trade-off between a borrower's preference for short-term debt due to private information about the future credit rating and liquidity risks. Liquidity risk from short-term debt arises from the borrower's loss of control rents in the event that lenders are unwilling to refinance when bad news arrives. Liquidity risk is a risk that a solvent but illiquid borrower is unable to obtain refinancing. The model fits this characterization because, even without using their private information, some borrowers who are liquidate would invest their own capital to avoid default. The model characterizes borrowers who are averse to bearing this risk. The main result is that there is a credit rating such that those with higher rating prefer short-term debt as a type of bridge financing that allows them to choose to refinance when good news arrives, while lower-rated borrowers prefer long-term debt. In addition, some very low-rated borrowers have no choice but to use short-term debt, despite the control that it gives to lenders. The model thus identifies two categories of short-term borrowers: the low-rated who have no choice and the high-rated who use short-term debt to time their borrowing to take advantage of the arrival of information. Borrowers with ratings in between this rely more heavily on long-term debt. The model measures the borrower's credit rating for a given amount of leverage, and this might alternatively be termed as a credit reputation. Another interpretation of the model is of the choice of debt maturity for a leveraged buyout, conducted by incumbent management who have private information about the firm's prospects. Liquidity risk arises from debt that is of shorter maturity than assets. A key determinant of the actual calendar maturity is the timing of cash flows. This paper extracts from cash flow timing differences and provides a theory of the gap between debt maturity and asset maturity. Short maturity debt creates liquidity risk because sometimes the borrower is unable to refinance and the lenders liquidate when the borrower would not choose to if he or she were the sole owner of the firm. Short-term lenders liquidate too often from the borrower's point of view because they are constrained on pledging future rents to lenders. The amount that can be pledged to lenders may be less than the value they receive from liquidation. Yet the total future rents exceeds the liquidation value. These constraints arise from many possible sources: private information by borrowers, moral hazard, and monitoring costs. These contracting problems imply that difficulties in obtaining initial financing persist at financing time and can lead to excessive liquidation. This approach to modeling liquidity risk differs from that in Diamond and Deeper, but the two approaches are complementary. In Diamond and Deeper, lenders refuse to refinance and illiquid borrowers who would otherwise remain solvent because of strategic uncertainty about other lenders' actions. The approach in this paper built on Diamond 1987, which illustrates the liquidity risk of attempting a refinancing from borrowers subject to moral hazard. My analysis, especially that in section 4, also relates to Hart and Moore, who show that some types of debt renegotiation provide a disadvantage to short-term debt. Hart and Moore also analyzed several more general renegotiation issues unrelated to maturity structure, and that paper and Scarfiston and Boston examine effects of inefficient liquidation under asymmetric information. Also related is Sharp, who concludes that all debt should be long-term in a model where liquidation is never efficient and all information is public. The second element of this paper's model is private information of the borrowers. A borrower's willingness to choose short-term debt and thus subject his or her financing costs to new information might depend on the private information. Flannery, 1986, presents a model of this influence on maturity choice when there is no liquidity risk. His model implies that all borrowers select short-term debt unless short-term debt causes higher transaction costs, because no borrowers have reason to prematurely reveal bad news about themselves. I incorporate liquidity risk, and this leads to a trade-off for borrowers because short-term debt can lead to lost control rents. In my model, even borrowers with information that their credit rating is likely to improve can prefer long-term debt. Section 2 outlines the basic model. Section 3 describes the information that will arrive about borrowers and shows how lenders respond to the information given short and long-term debt. Section 4 presents some simple examples to illustrate a trade-off between the liquidity risk of lost control rents and the incorporation of new information about the borrower's credit rating into the cost of financing. Section 5 develops a model in which to compare several types of debt contracts. Section 6 shows how the borrower's credit rating influences maturity structure choice. Section 7 generalizes this to an optimal mix of short and long-term debt. Section 8 discusses firms whose credit rating is so poor that no one will lend long-term. Section 9 provides some more general motivations for the existence and magnitude of non-assignable control rents. Section 10 uses a game-theoretic equilibrium refinement to show that the equilibrium is reasonable. Section 11 concludes the paper. And that's all for today's reading. Thank you very much, and see you tomorrow.